Welcome to the deep dive. Our mission today. Well, it's not just looking back at the GameStop thing in January 2021. It's really about understanding how, for a few wild weeks, the internet seemed to take on Wall Street and maybe even win for a bit.
Exactly. This story, it went way beyond just stock tickers pretty fast. It really questioned the whole structure, the assumptions of global finance. It exposed these like hidden technical weak spots,
Yeah.
forced actual regulatory changes, and maybe most importantly, it kind of wrote a new playbook for how people can band together against the big market players.
So, okay, let's paint the picture. January 2021, GameStop. You know, that video game store in the mall.
That's
Struggling.
right.
Definitely struggling. Brick and mortar facing tough times.
And then boom, suddenly it's the most traded stock
Yeah.
on earth. It's just mind-blowing.
Yeah.
You had Elon Musk tweeting GameStop, and suddenly billions are shifting hands. It felt like the whole system was teetering.
It absolutely was an unprecedented moment, and it was driven by this army of retail investors, ordinary people, the apes.
The self-proclaimed apes, yeah. They used those commission-free trading apps, coordinated on social media, specifically Reddit, that Our Wall Street Bets forum.
Which was, let's be honest, a pretty wild place even before this.
Oh, absolutely. Highly irreverent. But suddenly it found this financial lever big enough to actually move the market significantly.
It did. The stock price, GME, it surged, over 1,600% by early February? That's just staggering.
It hit an intraday high, I think January 28th, around $500 a share.
Insane. So for 1 week, this incredible kind of dizzying week, it genuinely looked like maybe 1 million small investors were winning this financial war against the big Wall Street institution.
That's the key takeaway, really. Social media wasn't just for memes anymore. It was a tool for, well, financial disruption on a massive scale. For the first time, really.
Okay, so to get why this war could even happen, we need to talk about the vulnerability, right? The hedge fund's position.
Right. It comes down to short selling, which in simple terms is just a bet that a stock's price is going to fall.
You borrow shares.
Exactly. You borrow shares, sell them immediately hoping the price is high, and then plan to buy them back later when you hope the price is dropped. Pocket the difference.
But the risk, if the price goes up instead.
That's the killer.
Yeah.
The potential loss is theoretically unlimited
Yeah.
because the price can just keep rising.
Which is why they started panicking when GME took off.
Precisely. And GameStop was this perfect storm target. Hedge funds had bet huge amounts against it.
Right.
I mean, the business outlook wasn't great, let's be fair.
Right.
This led to what's called short interest being incredibly high, like extraordinarily high. We're not talking 50%, 80%.
It was over 100%, wasn't it?
It reached about 140% of the publicly available shares.
Hang on, how can you short more shares than actually exist? That sounds fundamentally broken.
It does, doesn't it? But it happens. It's a quirk or maybe a flaw in the system called rehypothecation. Basically, the same share can be lent out, sold short, lent out again by the new owner. Yeah. So it creates this massive hidden leverage, this instability, like a coiled spring, just waiting for the price to move sharply against the shorts.
And the Reddit community, they basically jumped on that spring.
They did. Through sheer collective action, organizing this mass buying frenzy, driving the GME price up, up, up.
Forcing the short sellers, the hedge funds, into the short squeeze.
Exactly. They had to buy back shares to close their positions, to stop the bleeding as prices rocketed. But buying shares just pushed the price even higher.
A vicious cycle for them.
A devastating one. It caused staggering losses, billions. The most famous casualty was Melvin Capital.
Right, Gabe Plotkin's fund.
Yeah, they lost 53% of their capital, about $6.8 billion. In January 2021 alone, it showed that retail coordination could actually inflict potentially fatal damage.
So things are chaotic, the price is soaring, and then the pivot point, January 28th. GME's hitting its peak. And suddenly, these popular free trading apps, Robinhood being the most famous one, they freeze buying. You couldn't buy any more GME or other meme stocks. You could only sell or hold.
And the impact was immediate. The price just plummeted.
Yeah, cut off the demand. It went from nearly $500 down below $200 in hours.
And instantly, you had this feeling among retail traders. Outrage. They felt cheated. The question that everyone was asking was this deliberate? Was the game rigged to save Wall Street?
Robinhood, their CEO, Vlad Tenev, they swore up and down it wasn't malice. They said it was purely technical.
Right. They blamed the plummeting of the market, this systemic vulnerability linked to the T+2 settlement cycle.
Okay, T+2. Remind us why that 2-day delay is so crucial here.
So T+2 just means there's a 2-day lag between when you make a trade and when the actual cash and shares officially change hands. It settles 2 business days later.
Standard procedure.
Usually fine. But when you have insane volatility like with GameStop, that 2-day gap becomes incredibly risky for the brokers. They have to post huge amounts of collateral, basically, cash deposits, with the central clearinghouse, the NSCC, to guarantee the trades will eventually settle, even if one party goes bust in those 2 days. With GME's price swinging wildly, the calculated risk shot up exponentially.
Ah, okay. So the volatility itself created this massive sudden debt risk because of the delay.
Exactly. Robinhood suddenly got hit with a collateral call from the NSCC for billions of dollars, way more cash than they had readily available.
Billions. Instantly.
Reportedly, a $3 billion demand, which they negotiated down, but still huge. They had to restrict trading, especially buying, which increased their exposure, simply to reduce that risk and meet the clearinghouse requirements. So technically, it was the plumbing that failed.
Okay, technically plumbing, but let's be real. Even if the reason was technical, the effect, well, it pretty much only helped the institutions getting squeezed, right? It stopped the bleeding for the short sellers.
That's the unavoidable perception.
Can you really separate the technical trigger from the outcome? That feels like the core of the whole controversy, the thing that sparked the outrage and the hearings.
You've hit the nail on the head. The outcome was that the system's mechanics ended up protecting the big players, while the small retail traders got locked out right at the crucial moment. And that's why this whole saga actually matters to you, listening right now, even if you just have a standard 401k.
Right, because the system that almost buckled under the strain that week, that's the same system underpinning all market transactions, your retirement fund, your IRA, everything.
The GameStop mess starkly revealed T+2 as a major weak link. The potential for systemic risk was suddenly very real, and that crisis directly forced a major change. The SEC mandated a move to T+1 settlement.
Cutting the delay to 1 day.
Exactly. It happened in 2024. Cutting that settlement time halves the risk exposure window, reduces the collateral needed in volatile times, makes the whole market safer. That's a direct, lasting legacy of this retail revolt.
Okay, so that's one big takeaway. What else got exposed? The free trading thing, right? Payment for order flow. PFOF.
PFOF.
Yeah.
This is the business model for apps like Robinhood offering commission-free trades. They don't charge you a fee per trade.
Sounds good.
But they make money differently. They sell your actual trade orders, your buy order for Apple, your sell order for Tesla, to giant market-making firms like Citadel Securities.
Wait, they sell my order.
They sell the right to execute your order. The market maker pays Robinhood for that flow of orders. They then execute the trade, often profiting from the tiny difference between the buying and selling price, the spread.
So Robinhood's giving me a free pass to the amusement park, but they're selling my ride data to someone who might, I don't know, adjust the ride speed slightly for their own benefit.
That's not a bad analogy, actually. It creates this potential conflict of interest. Is the broker prioritizing getting you the absolute best price instantly, or are they prioritizing the revenue they get from selling your order to the highest bidder?
Yeah, that doesn't sound great.
Congresswoman Alexandria Ocasio-Cortez really hammered this point. She argued, look, if your order flow is being sold, then your trading isn't really free. There's a hidden cost.
And then, maybe the most powerful narrative hook of all, the feeling of a double standard.
Absolutely blatant in many people's eyes. On one side, you have Melvin Capital hemorrhaging billions.
And they get a bailout.
A $2.75 billion lifeline pumped in by their Wall Street peers, Citadel and Point72, to keep them afloat.
Okay. And on the other side?
The retail traders, the apes who are winning, they get locked out. The buy button gets disabled right when the pressure is at its peak.
It just looked bad, really bad.
It created this deep, lasting sense of injustice. Many framed it as like the first real digital age class war fought inside the financial system itself.
To really grasp that intensity, we should probably talk about the key characters in this drama. First up, the icon, right? Keith Gill, Roaring Kitty.
Or deep fucking value on Reddit. Yeah, Gill was absolutely pivotal. He wasn't just some random guy yelling by. He was a former financial analyst.
Right, he had credentials.
He posted detailed research, videos, spreadsheets, genuinely arguing from a value investing perspective that GameStop was fundamentally undervalued, even before the squeeze potential.
So he provided legitimacy.
Crucial legitimacy. His conviction turning, a $53,000 initial investment into reportedly almost $50 million at the peak, that narrative powered the whole movement. When he testified to Congress, he just said, very simply, I just thought GameStop was undervalued. Powerful stuff.
Then there's the flip side, the main casualty. Gabe Plotkin of Melvin Capital.
He became the face of institutional failure, really. Losing that $6.8 billion in a month, needing the bailout, and ultimately having to shut down the entire fund in 2022. For the retail crowd, that was a huge symbolic victory. It proved they could take down a giant.
Okay, who else? The gatekeeper. Vlad Tenev, Robinhood's CEO.
Tenev was right in the hot seat. He had to defend that decision to halt buying, insisting it was purely about the clearinghouse collateral calls.
Under oath.
Under oath, yeah. Denying any pressure from hedge funds or market makers. But his testimony was central to figuring out, was he protecting his platform stability or protecting his business partners who were paying for that order flow?
Which brings us to the market titan, Ken Griffin of Citadel.
Griffin's position was uniquely complicated. Citadel has two arms. The giant market maker, Citadel Securities, which pays Robinhood for order flow.
Right.
And a massive hedge fund, which was one of the firms that bailed out Melvin Capital.
Ah, so the conflict of interest accusations flew.
Immediately. Was Citadel influencing Robinhood to halt buying to protect Citadel's investment in Melvin? Griffin vehemently denied it under oath, pointing to the technical clearinghouse issues.
Yeah.
But the optics, as you said, were just terrible. Citadel pays Robinhood, Citadel bails out Melvin, Robinhood halts buying that's hurting Melvin. It looks suspicious, regardless of the technical explanation.
And one more interesting character, Adam Aron, the CEO of AMC, another meme stock.
Aron played it completely differently. AMC was also heavily shorted, caught up in the frenzy. Instead of dismissing the retail investors, the apes,
He embraced them.
totally embraced them, engaged directly on Twitter, acknowledged their ownership. They owned like 80–90% of AMC shares at one point. He used that massive retail support to raise vital capital for the company, saving it from potential bankruptcy. It showed this completely new way of running a company where retail sentiment could actually drive corporate strategy.
Wow. Okay, so pulling back from the characters and the chaos, this whole thing leaves us with some really big questions about how markets work, about fairness, about power. Let's maybe tick through the main themes this deep dive will explore. First, power versus plumbing.
Yeah, this is the fundamental debate. Was the system rigged against the little guy, a power issue, or was it just, built with faulty plumbing, a technical structural issue that broke under stress? Can fixes like T+1 settlement solve it, or is the problem deeper?
Second, collective action online. This proved it works, right? Memes, Reddit DD, due diligence. They can actually move markets and inflict real pain on institutions.
Absolutely. Proof of concept. But then the question becomes, how do you regulate that? Can you manage this kind of decentralized power without just crushing free speech or innovation? It's a huge challenge.
Third, market democracy versus market control. We got free trading apps, more people participating. Sounds democratic.
Right. Access was democratized. But the halt showed that when things get volatile, control over liquidity, who can actually trade, is still very centralized. With the clearinghouses, the big brokers, the market makers. So who really holds the keys to market access when it matters most?
Fourth, this strange political alignment. Populism across party lines.
It was remarkable, wasn't it? You had progressive Democrats like AOC and Rashida Tlaib and populist Republicans like Ted Cruz all basically saying the same thing.
Yeah.
The system protected Wall Street and screwed over Main Street. A rare moment of bipartisan outrage against the financial elite.
And finally, legacies and lessons. What actually changed?
Well, we got T+1 settlement, which is significant, but the bigger fights, banning payment for order flow, making short selling more transparent, those are still incredibly contentious debates years later. So some plumbing got fixed, but the fundamental arguments about fairness, they're very much ongoing.
Okay, so this deep dive today, this is really just setting the stage for a much bigger story we're going to unpack. We'll dig into the origins of our Wall Street bets, the minute-by-minute crisis of the trading halt, the congressional hearings, the aftermath.
And it's crucial, I think, to see this not just as dry finance history. It's really a story about belief, what people believed about the stock, about the system. It's about technology enabling collective action. And ultimately, it's about trust, or the lack of it, in financial institutions.
And it wasn't a simple wealth transfer either, was it? From institutions to retail.
No, the reality is much more complex. Yes, some early retail buyers made fortunes, but many others who jumped in late, near the peak, they suffered significant losses. A lot of wealth was simply redistributed among different groups of retail investors, as well as from some funds to some retail.
So the GameStop saga, it proved one thing for sure. Retail investors aren't just dumb money anymore. Not when they coordinate. It exposed some deep, maybe uncomfortable truths about how the market works, the double standards. The big question going forward seems to be, can the financial system adapt to this new reality, this empowered, connected retail investor? Or will it just find new ways to, well, manage and monetize that energy?
Every 401k statement you get, every time you use a trading app, every headline about market reform, it's all connected back to that wild, chaotic week in January 2021. This is where we start.
Thank you for taking the time to listen to this podcast. If you enjoyed this introductory episode, please join us to learn more about the Ape Army, how the dumb money crowd brought Wall Street to bear. Please consider liking and subscribing to the channel so that more listeners like you can follow this important story. We look forward to you joining us for Episode 1, The Revolution in a Nutshell, where we look into the origins of the Ape Army. Until then, be well.